Welcome to Hedge Fund Tips with Tom Hayes. I'm Tom Hayes, and this is VideoCast episode 79, podcast episode 69 for the week ending April 23rd, 2021. And as always, we'll kick it off with the media spots, cover a lot of key points in a short amount of time, and then get down to the meat and potatoes of this week's episode. So first, I'd like to thank David Lynn and Michelle McQuarrie for having me on Kitco News, which was my first time. They're a big metals dealer, and I know Michelle from when she ran content over at I-24 News. She made the move to Kitco. She said, why don't you come on? I said, I'm not really a metals guy. And she said, no, we'll do a global macro segment for you. And it was just great. Over 50,000 views. They have such a huge audience. You can watch it on YouTube. So I want to thank David Lynn and Michelle McQuarrie over at Kitco for having me on. So we covered quite a lot. This was a long form interview. I don't do many of them. I do for CNBC Indonesia, usually once every month or two. Big half hour on emerging markets and commodities and that type of thing. But this was a great experience. And, I'll touch on some of the key themes. I know many of you have watched this, but it bears covering some of the highlights. First, obviously, the bad news is it's harder to find value in this market, up 85 some odd percent off the March lows. The good news is there is still selective opportunity. There's cash on the sidelines. Institutions have been net sellers. Retail flows have been higher, but that hasn't really worked as a good contraindicator of late. And then we see naturally the deaths declining, the 7-day moving average, the vaccinations topping hit 4 million in a day, 3 million a day average, 40% of the population fully vaccinated, and a lot of good things happening. Ordinarily on such a dramatic move, there would be an inclination to get extremely defensive or bearish, and it's tough to do so when you have a situation where we had a 3.5% GDP contraction last year, which is 750 billion, but we've already done 5.3 trillion in fiscal stimulus, 4 trillion in balance sheet expansion, money supply up 27% year on year, another 2 to 3 trillion coming in the Green New Deal, and then it looks like another trillion or two coming in this family plan that I'm hearing more and more about in coming weeks, albeit there's going to be some pay-fors with new taxes, which we'll get into that. A lot of people got worried about capital gains taxes for the wealthy. It's not going to be as bad as everyone thinks. So you can just, take a deep breath at the early part of the call. We'll get a little more granular as we go through here. But, with that amount of money in the system, you don't have to think twice. Why are prices doubled at the pump in the last year? Why is there a bidding war if you want to buy a house? No one's buying at market. It's a question of how much over ask you have to pay. And these are signs, the next thing that everyone's got to be looking for is wage inflation. If you start to see the wage inflation, which you will, there's nothing transient about wage inflation. Wages are sticky. So you want to be in this type of environment, you want to be in assets. If you're in cash, bonds largely, you're going to have an erosion of wealth. So that's why you're seeing money go into real estate. You're seeing money go into equities. And this week, the top performer was REITs, real estate investment trusts. So you're going to see more and more of that type of behavior because you just can't. I mean, certainly you can slow it down by increasing taxes. The corporate tax rate will probably go up to 20, maybe 25. Worst case, 28, and it won't go higher than that. But 25 should be the number. The capital gains, maybe it'll go up to 28, but I said, we'll cover that in a second. So, and I covered with David last year, we were pounding the table on banks, energy, and defense and aerospace stocks when you couldn't give them away. Now everyone wants them. There is room to run for sure. We're only 1 year into the new cycle, into the bull market. They took a rest in the last month. There are some reasons why it looks like they might start to get bid again. As far as the bank earnings, they couldn't have been any better. Yield curve's the steepest in a handful of years. They over-reserved on the basis of a 20% unemployment assumption. It's now a 6% reality. They released a ton of those reserves we saw last week. And they took up dividend and buyback guidance. So everything is in place. We're also going to see a tremendous rationalization of their operating footprint. JP Morgan says they'll need 60% of the space. Why is that? That number one, they realize that they can deliver a lot of their products digitally. People have changed their behaviors. That's number one. Number two, most of the back office can work remotely, and that's going to be a huge boon to efficiency ratios and cost moving forward. So these things are going to be money machines. They already are. And we think, we're overweight in the best opportunity, which is Wells Fargo, moving forward. And we'll talk a little bit about that. As far as energy, the biggest risk with energy is that we bend over and give Iran everything, in which case they're going to put a lot of supply on the market pretty quickly. But that said, OPEC seems to want to maintain control of things, so they won't be quick to reduce their cuts with Iran coming on market. And I think we could get some equilibrium at this price level, which is fantastic for the producers. And what we're seeing in the last 24 hours is obviously this huge push to sell the Climate Action Initiative with 40 global leaders that Biden led the video conference. And what you're seeing is, since the election, this is ultimately going to help the existing players left in the oil and gas sector. A number went bankrupt in 2016, number went bankrupt last year. And the ones that are left standing, there'll be a few more that teeter. But, the minute this changed on election day, what we've seen, which is very interesting, is that the energy sector ETF, counterintuitively to what most people thought, the XLE is up 61% since election day. Just over 5 months. And the biggest clean energy ETF, ICLN, is up only 22% over the same period. Exxon's up 68% since election day. Chevron's up 40%. ConocoPhillips is up 63%. A refiner, Phillips 66, is up 62%. EOG's up 103%. So, they've had a dip in the last 4 to 6 weeks, and I think that's going to be a tremendous opportunity here as we look out 3 years later. Look out 3 years, because the key is, the goal here is to kill the fossil fuel industry. The problem is the amount of demand that's going to be required in the interim is just staggering. So what's happened in the last 5 years, there's been no meaningful investment. You're going to have, Biden was talking about hiring people to cap wells and this type of stuff. It's going to bring the price up. It's going to allow the remaining producers to mint money. And that money is no longer going to be shoved back in the ground like it was recklessly done so in years past. It's now going to be returned to shareholders in the form of dividends and buybacks. And my sense is, with the nature of the tax code changing, it's going to be more buybacks than dividends. So you can expect tremendous amount of appreciation for the remaining players. And this is just a tremendous opportunity, because until the clean energy initiatives can produce viable energy alternatives at scale, which they're nowhere close to, we're going to be using a ton of oil, and it's going to get, even as the price continues to go up and up and up, which it will. So that's an opportunity. But late February, early March, we started talking utility staples and pharma. They've had monster moves in the last 6 weeks, now 7 weeks. The laggard was big pharma, which had a huge move in the last week or so. This was yield-sensitive plays that were that had been sold off when the 10-year yield rate of change accelerated dramatically from 100 basis points to 175 basis points in 5 weeks. We made the call that that was going to moderate. It's done that. It's now back in the 150s to 160s range, and these stocks have taken off. They're now, I think, due for a short pause, but the nature in the weeks and months forward, I think there's more juice in this trade. Probably 60% done, 50% done. I think it's got a lot of juice. There was some opportunity in staples this week, which have had big runs. They sold off due to pricing pressures, but that's going to be passed on. So I think that's an opportunity, and we topped up a couple of those on weakness. So we like that. And then the thesis, besides all the cash in the system, why you can't get too bearish here despite the huge move off the lows, is that my sense is that GDP estimates are too low. At 6% consensus, we think it's going to come in closer to 7 to 9%, maybe even 9.5%. And earnings are certainly too low. They were at 175 last week. At the time of recording this with David Lin, I think it was at 176. It jumped up to 178 midweek, and I think we're a bit higher. We're going to see at the end of this call. The new data is out today. So I think what you could see is, rather than 175 or 178, maybe more likely closer to 190, or even possibly a two-handle for 2021, when that was the estimates for 2022, in which case the multiple is not so outlandish, number one. But number two, you still have to be shrewd, I guess is the word, and look for not chasing the things that are up so much, but actually looking. There are existing pockets which we've jumped on in the last 7 weeks, but there are new pockets we're going to talk about on this call that are starting to sprout up, things that are down 30+% in the last handful of weeks, where we think there can be also opportunity moving forward. Lower conviction level and specificity than what we had with utility, staples, and big pharma. We still like those plays, but I think if you buy baskets of the groups we're going to talk about here, even with the lower conviction, you're going to do nicely because they're down enough. And then finally, we talked with David, and we closed out on some of our big picks for big pharma, which were the laggard at the time, but they've had a huge move in the last 7 days since that interview. We talked J&J. We said that the sell-off on the vaccine was overdone. It's rallied tremendously. And by the way, after hours tonight, their vaccine got approved, which is what we said would happen, either with a label on it or contraindication. But, it was a 1 in a million event, 6 people out of 6.8 million. It'll probably continue. We'll see more people getting clots, but it'll be like, 20 million people vaccinated, a couple hundred people with clots. Terrible, horrible situation. But, that's the same with any vaccine. It's no different than adverse events on the flu vaccine. So we do have to keep some of these things in perspective. So that was that. And the other point that I was making with regard to J&J is, one, it was oversold on that, but two, it was such a small part of the business. The pharma momentum with Remicade and Stelara is 50% of the sales. Medical devices, a third of the sales, and consumer division, baby oil and Band-Aids, is 20% of the sales. Then we were talking Pfizer. Pfizer had a huge move after the interview, it was up 10% at the interview. It got up close to 20%, trading at 12 times next year's earnings, 14 times historic multiple, 4.2% dividend yield, 2.5 times the 10-year yield. They're going to do 15 billion in sales on vaccines. That was before the booster. Now it could be a lot more than that, because they're saying we're going to need a booster in 6 months. And then their blood thinner business, among others, Eliquis, is up 17% year on year. And then finally, the big laggard that I think could be a tremendous opportunity in the next 4 to 8 weeks is Novartis. Has nothing to do with COVID. It's just a play on the second half healthcare normalization when people go back to their doctors. Their Entresto heart failure drug is doing tremendous. Their Cosentyx psoriatic arthritis, trading at 12.5 times 2022 EPS versus their historic multiple of 22 times. 3.6% dividend yield, etc. So we talked a bit about the commitments of traders, which we've touched on, that short-term bounce in bonds, compression of yields is a short-term counter trend. Commercials are starting to buy, but they're not buying at a level that I would say, the sell-off in bonds is done. Usually they buy ahead and they start to buy in size as you get closer to a bottom. So I think a reasonable expectation, despite what should be a short-term counter-trend bounce, compression in yields, bounce in bonds, should be, maybe around a 2%, maybe as high as 2.25 by year end. But I'd probably be inclined to be more towards 2, and that's not a big deal because it's, albeit it's, 25 basis points more than the recent high at 175. The rate of change is going to be a lot slower and the market can digest it, versus 75 bips in 6 weeks was a lot. And that created the opportunity for the yield sensitive stocks, utility staples, and pharma. US dollar, short term, could have some strength. As commercials have been buying. I'm kind of agnostic on the dollar, no strong view there. And then sentiment is still hot. However, 66%, if you remember from last week's Bank of America Global Fund Manager Survey, 66% are still saying this is a late stage bull. So they're missing the opportunity of being positioned for early stage bull versus late stage bull. We had 2 quarters, we had the recession, we had all the things that precede a new bull market. So so that's that. And then AAII and National Association of Active Investment Managers we covered, which we'll get the new data on this call. Moving right along. So thanks again to David Lin and Michelle Macari over at Kitco. Then I was on that night on CGTN Global Business talking about China. That actually came in handy because some of the groups that have sold off materially 30-40% in the last few weeks, one of them is China. So we are looking very, very, very selectively at high quality names there. We like some of the casino operators. Las Vegas Sands has sold off their Las Vegas business, so now they're a pure play on China effectively in Asia. Melco Crown is a smaller operator, and some of those, and we'll talk about some other Chinese stocks that we're looking at. But the key of the call was about China GDP print, which was up 18.3% year on year, which was slightly lower than estimates of 19.2%. And it was coming off a very low, the base effect. It was coming off depression lows from last year for the year-on-year number, which was negative 6.8% last year in Q1. So if you look at Q1 over Q4, their GDP was up only 0.6%. So they're still growing at a tremendous clip. But I think the short-term headwinds is the government started tightening on stimulus, and in my view, too quickly, and I've said that on CGTN for the last 2 months. It's too early to start tightening up policy before you get a global economic recovery. There's not enough internal demand domestically to grow at this level. So we'll see if they maybe slow down their tightening. But the strengths, obviously, their exports have been tremendous. They're the only developed economy to have positive GDP plus 2.3% last year. They hit pre-pandemic production levels, GDP levels in September of 2020. All the patio furniture, electronics, computer equipment, video consoles as people were home, tremendous exports. And they've put a lot into infrastructure. While we gave a lot of money directly into people's pockets, they put it into long-term investment infrastructure. There are cranes everywhere, highways, railroads, charging stations, and big property investment. Their home sales were up 95.5% year on year. Their real estate investment, lot government-driven, was up 25% in Q1. So where they're so far lagging, had been lagging, was in the consumer. And that was a function of a government policy. So they lagged on the vaccine rollout. They were behind the pace of the US materially. And that hurt consumer confidence because every time they had a flare up, the government would just shut down all businesses in that area and it would just stop. And when you have that level of job uncertainty, income uncertainty, and regularity in your schedule, you rein in your consumer spending. You get worried about making your bills. Both, one, you don't want to spend. Two, you don't know if you're going to have a job if there are 10 cases of COVID, they shut down the whole city for a number of days. So as their vaccines roll out, that confidence is going to come back, and we started to see it in the most recent retail sales print was up 34% year on year versus 28% estimate. So that customer is coming back. It's because of the vaccinations. The government's starting to push people. The other reason a lot of people weren't getting vaccines, one, they didn't have them, but then when they got them, people were like, well, there's very few cases in our country. Why should we get a vaccine? Government's now promoting it to go get the vaccine. So that customer is going to come back strong. And material, and I think the shutdowns, the random shutdowns are going to stop. That'll bring back consumer confidence, and that's why we think some of these stocks are overdone to the downside and could be great opportunities. Beijing has a 6% target GDP for this year. Wall Street consensus is 8.5 relative to I think the U.S. could come in at 9, and I think 8.5 would be certainly reasonable, if not a little more in China. And that recovery is going to continue so long as they don't rein in the stimulus entirely too quickly. So that is really the risk is government policy. And they're doing that because some pockets of the economy are overheating, which is why they set their GDP target low at 6%. But, it's a balancing act. I think you're better off overheating in the short term, like Powell has said, and then reining it in later. They do have inflation starting to rear its head with the producer price index came in at 4.4 versus 3.5%. So producers are having to raise prices like appliance manufacturers, refrigerators, dishwashers, etc., because the raw materials, the metals and copper, etc., are going up in price. So their recovery has been driven by infrastructure and property investment. The consumers are going to be the next phase, and as the government encourages vaccinations and they get those delivered, that sentiment's going to improve. And I think their GDP is going to exceed targets, which is why we want to start to nibble on the highest of high quality Chinese stocks that are down anywhere from 30, 40, 50% in the last handful of weeks. So thank you to Rochelle Akufo, that's the host and anchor, and Stephanie Savage, for the producer, for having me on. We did the VideoCast last week on Thursday, so this article came out after that. And this was after bank earnings. My quote was, "You're just seeing blowout earnings from the banks and all the data pointing to a very strong reopening. So today for the so-called reopening trade with strong financials. The biggest risk that could cause the stock sell-off is the development of COVID variants, a slowdown in the reopening, and persistent inflation." So thanks to Shivani Kumarasan for including me in that article. I appreciate that. And then on the 19th, which was, I believe, so that one was Friday the 16th. Yeah, that was after the podcast. And then Monday the 19th, IBM was going to report after the bell. I said the market is waiting to see if the blowout earnings in banks will continue to other sectors. One of the things the market's looking for is increased participation among tech stocks, which have lagged in 2021. So that's going to be key. The first FANG stock, Netflix, whiffed. So the stock was down, I think, 9%. So the market is kind of in an information vacuum, waiting to see the rest of the FANG stocks report next week and whether they can, exceed expectations and show decent guidance. It's going to be tough because they pulled forward a lot of growth last year. So I'll be very focused on seeing the guidance moving forward. So next week's going to be big. I'll be on TD Network on Wednesday at 1:45 p.m. talking about some of the earnings, the tech earnings. So you definitely want to check that out. And thank you to Shivani Kumarasan for having me on that article on Monday. And then on yesterday was really interesting. Actually, there were two things. So in the morning, the market was doing nothing, and it was like fluctuating between positive and negative. And my quote was, "The most important catalyst is waiting for key FANG earnings next week. That's going to tell us the next 50 points on the S&P, either up or down. In that information vacuum, the market's really struggling for direction. The market's a little bit concerned about coronavirus cases flaring up in India. They had record cases that day. And in parts of Asia, which have not had vaccine rollouts as strongly as we've had in the U.S. That affects global trade, global commerce, etc. So that was weighing on the markets. But then the big bomb drop, which was interesting because I wrote the article Wednesday night and I said, "Don't rock the boat, baby." And the basis was the market's priced for perfection based on current estimates, but we think estimates are going to go up. And if they go up to the extent we think they're going to go up, the forward multiple becomes very reasonable and fairly valued. But, since we are priced for perfection, don't rock the boat, baby. And sure enough, at 3 o'clock, or no, it was like 1 o'clock, Biden, the headline hit that Biden's talking about a 43% capital gains tax rate, economic suicide. And so Herb Lang called me, Herb Lash called me, and Herb has been great. And he said, what's going on? The market's down 300, the Dow's down 300 points. And I said, Herb, if this bill had a chance of passing, we'd be down 2,000 points. So don't worry about it. and that was my quote. And sure enough, the market closed down about 300 points, not 2,000 points. And then today it was up big. So, thanks to Herb Lash, Trevor Honeycutt, and Jarrett Renshaw for including me in their article on Thursday. And by the way, a friend of mine called me. Apparently, Larry Kudlow was on Fox News about 2:30 or so today, and he quoted me in this Reuters article saying that not to worry if this had a chance of passing. Tom Hayes at Great Hill Capital says we'd be down 2,000 points, and look, we're up today. He was right yesterday. So thanks, shout out to Larry Kudlow for mentioning me on Fox News, and he has his own show on Fox Business every night at 4 o'clock. You want to tune in for that right after the Clayman Countdown. So that was that. All right, moving on. We've covered a lot, but this is from Almanac Trader. This is Yale. Jeff Hirsch, he's the son of Yale Hirsch, who started the Stock Traders Almanac. And, everyone knows about the worst months of the year. Sell in May, go away. So it's basically May, June, July, August, September, October are the worst 6 months of the year. But his data shows that in the post-election year, the worst months on average are not so terrible as they are ordinarily. So next year, the midterm year, is the worst time to be long stocks in the worst 6 months of the year. So next year from May through October is a bad time to be long stocks on average since 1950. So the post-election year on average, you're up during that period on the S&P 500, 2.39%. So, that gets us closer to our mid-teens target for the year. If we add that on, and more than anything, we're as we've continued to pound the drum, not paying attention to the general indices this year. We're looking for the rallies under the surface and sector rotation. That's our knitting. That's where we score, and that's what we're going to keep delivering. Okay. This is interesting. This came out this week. Nearly half of Americans are too nervous to invest in stocks right now, new survey shows. Allianz showed that 48% of Americans don't want to take action in the equity market. 75% of Americans foresee stock market volatility picking up again in 2021. Analysts say more volatility is likely in store as more strong economic data challenges the Fed signaling on interest rates. By the way, Ryan Dietrich actually put out some data about what happens to the stock market after the first rise in interest rates, and it's actually bullish. The Fed started raising rates, by the way, I think in 2003, and the market rallied for another 4 years. So or maybe it was 2004, but either way, you had many years and many positive things happening right there. Why I bring up this article from Business Insider is because it shows there's still a wall of worry despite all the optimism and despite the big move. A lot of people that are still underweight. And then for those people saying, well, you've had all these flows, more flows in the last 6 months than the last 12 years. But the fact of the matter is equity flows relative to bond flows over the last 12 years have been de minimis, and there's a huge catch-up trade in the offing because people have been so defensive. Part of that was obviously war wounds from the great financial crisis, but also that generation, the baby boomers, were getting closer to retirement, so they didn't want to take any risk, and they put it all into bonds at the worst time when the market was going up. So now that they're older, they're less important. The newer money, Gen X, which is a smaller generation, my generation, the forgotten generation, but the millennials now have a lot of money, and they're going to be all equities based on their age. And then Gen Z, and remember, we've constantly covered millennials have bigger size. They have more numbers now than the baby boomers. Average age of 30, starting housing formation, they're going to be doing all equities, so they're offsetting that, and they've got to play catch up. There's going to be more equities, and the imbalance of bond flows to equity flows over the last 12 years is going to be flipped on its head over the next 12 years. I think you're going to see overflow of equities and probably an underweighting of bonds as people start losing principal, like it's going out of style, as rates slowly climb and principal erodes. So, and that's also a function of inflation. Okay, so moving on. Now, with the break we took, if you remember, we were saying for the last 4 weeks, we would expect, banks and financials were the top performers of the year. They still are, by the way. So we expected them to take a breather. They have. Are they ready to start to get bid again? Well, let's see. I mean, Bank of America put out this note, 10 reasons why the value stock resurgence has further to run. Not over, according to a note on Friday. Value stocks have outperformed growth stocks over the past 7 months, reversing a decade-long trend as investors anticipate a full reopening of the U.S. economy. And they put their 10 points. So their David Letterman top 10 list. Growth starts looking cheaper than value. Even after 7-month underperformance, growth stocks remain 1 standard deviation undervalued relative to value stocks remain 1 standard deviation. Growth stocks remain 1 standard deviation overvalued relative to value stocks. Okay, this was a typo. Value has outperformed growth for 33 months on average. It's only been 7 months of value outperforming growth, well short of the 33-month average Bank of America observed. So these red points are the inflections, and as you can see here, I think this is going to be much more than like a cyclical bounce like we saw in the 2000s. I think we're going to get a secular move here like we saw in early 2000s, a huge that's going to be driven by modest inflation, commodities, housing demand, and all the reopening plays like you saw in early 2000. And we're just starting. So this chart is more important than anything else on this chart, in my view. Give you perspective. Even though we've had this monster run in the last 6 months, we've taken a breath for the last 4 to 6 weeks, but we're just in the nascent stages of what I think is going to be a secular 3, 4, 5 year move here. Value has outperformed growth by 60% on average. Value has only outperformed growth Value has only outperformed growth by about 20% since the rally began 7 months ago, short of its 60% average. B of A said, okay, active funds are overweight value. Overweight growth. Okay, whoever wrote this article, Matthew, okay, I'm not going to name him, but he did not copy and paste properly. Okay. The active managers are still, so this should have said active funds are overweight growth. Active investment managers are still sticking with growth stocks despite the value rally and are 30% underweight value. That's correct. This chart shows it, that they're still underweight and they're going to have to play catch up. Active funds are equal weight financials and energy. Again, its heading is wrong. Underweight financials and energy, holding underweight positions of 6% and 26% respectively, according to Bank of America. So there's a huge catch-up trade in energy and financials just to get back to the mean, and it's just starting here. And B of A does not expect peak in profits growth until fourth quarter of 2021, according to the note. The U.S. regime indicator is mid-cycle, during which value has historically outperformed growth. Bank said, adding that prior mid-cycle regimes saw value outperform growth by 2.9 percentage points on average with a 71% hit rate. So that just shows the quantitative data. Biden promises that corporate tax, according to BofA, continues to advocate for 28% to help fund his $2.2 trillion infrastructure plan. According to BofA, the tax hike hurt growth stock earnings per share by 3 percentage points more than value stocks. So, in other words, if he gets the full 28, I think it's probably going to be 25%. It hurts growth stocks on a relative basis materially more than value stocks, which means value stocks will probably want to go where money will go where they're treated best, which is into value. The difference in valuation between growth and value stocks remains at extreme levels. We're 42% above the long-term median, just off of record highs, with growth being overvalued. That usually happens right before inflections, and the inflection has begun. And BOA expects a pickup in economic growth going forward, with GDP growth surge of 8% in the second quarter, followed by a growth of 11% in the third quarter. That's in line with what we've been talking about. So that's that. Another article from Yardeni in Barron's, Why the Reflation Trade Remains a Good Bet. And he's just talking about 250 million of Americans have received checks that add up to roughly $800 billion in cash available for sweeping through supermarket stores and shopping malls. GDP we talked about. Darby predicts roughly 30% earnings growth for the S&P this year versus last. Some forecasters are even more bullish. At Morgan Stanley, for example, strategist base case for 2021 S&P earnings is $193 per share. That's more in line with mine. Consensus is still in the 170s, and I think that's going to be the surprise of this year, and that's what's going to make the market look fair value. So when people talk about PE multiples, they're talking off of trough earnings. We're getting back to trend earnings, and when we do so, the multiple is going to look a lot more reasonable. And the beneficiaries of the high growth cycle have always been in the new stage of a bull market: cyclicals, value, financials, defense and aerospace, etc. Everything we loaded up on last year, and we're holding to this year. So that's that. And then Marco Kolanovic over at JP Morgan, who I quote a lot, says, get ready for the reflation and reopening stock market trade to kick into high gear, says JP Morgan's top quant. Our view is that the reflation and reopening trade will resume, with yields moving higher and rotation from growth, quality, and defensives to value and cyclicals. Value stocks saw their long-running underperforming versus growth deepen, and rising treasury yields, more stimulus. Okay, so the same story based on cases going down, demand going up as the COVID recovery takes place, reopening, reflation, inflation themes. And this is the key that hurts growth stocks. With you get inflation and rising rates, that's when cyclicals win. Value will significantly outperform growth. So that's what we're going to see in coming months. Whether the short-term rest is over or not remains to be seen. But that trade we've always said is going to come back for the second half in spades, and we still believe that to be the case. So a lot more people are getting behind it. Now, we've got more than enough that we need with the big pharma, and the utilities and staples are now taking a little break, but they'll resume. But I started to look for what's next. Where's the puck going? Because we've had a huge hit. I mean, we covered in the article this week how much some of those are up in the last 7 weeks. Certainly the banks, Wells Fargo was at a new high. I think it hit 44 today. So they're going to do what they're going to do, and we're in those for the long term. But what's next? And oddly enough, I was in 3 groups that I would never really naturally be in, but I look for, what's out of favor and what has a chance to inflect. And a lot of the stocks that were coming up were Chinese stocks, clean energy stocks that have just gotten taken to the woodshed in the last few weeks. Ironically, by the way, given that all the emphasis on climate change, I think that drum is going to start to beat a lot louder and a lot quicker, and all the new programs and the spending bills are going to include massive money for them, and people are going to say, why are these sold off now 30-40%? Well, they were up 100% on nothing. They got collapsed, and now they're back. And the overlap of the clean energy is SPACs. And there's a tremendous amount of money in SPACs that they all got driven up a lot. Retail and other speculation and hype. They're now crashed back down below the $10, which was their cash value. Both SPACs that have announced deals and SPACs that have not announced deals. And I think the hidden opportunity, which we put a number of on for clients and personally, there's no way to tell which are going to be the winners and the losers in the clean energy, nor is there a way to really tell which SPACs are going to be the winners and losers. It's highly speculative, but I do like buying after people got smashed. I like buying in the rubble, and I think enough pain has been inflicted to the people that were chasing these clean energy SPACs in the last 4 weeks, many of them down 50%, that not only can you get them at a discount, but many of these SPACs have one of my specialties. I worked with a group called Cornwall Capital. Many of you saw The Big Short, the movie with Brad Pitt, and so I worked with that group before starting my own firm, and they were exceptional at derivatives and pricing premium and pricing options. And one of the things that I know through years in the business, and I learned with them, and they were masters of, is effectively, I'm going to say this without qualification, and there are exceptions to this rule, but more or less, short-term options are for suckers. So where you can make money is if you understand the underlying company, and then you can buy longer dated premium at low implied volatility or lower than its historic mean, and let time and trend pay you exceptionally well. And that's just something that works. Most people lose their shirt in options because they're buying short-term stuff. And you could buy the short-term stuff if it's deep in the money and you're selling premium against it. But for some of these ideas, what's set up with this SPAC trade, now that many of them are busted SPACs, is that the warrants that were attached to these deals have also collapsed. And what's beautiful about them is they're effectively a leveraged play to where you get a long-dated option out to 2025 or 2027 that's now inexpensive because the baby's been thrown out with the bathwater. Good companies and bad companies alike have been thrown in the toilet. And because there's no perfect way to know which companies are going to win, there are 2 ways you can do this. Number one, you always want to bet on the jockey. So obviously someone who has a huge track record of success. A good portion of these people who have raised SPACs do have some level of historic success in the past. Otherwise, they wouldn't have been able to raise the SPAC. But you want to go to the higher quality people that have a track record of getting things done. That's number one. Number two, once you do that, then it's like, well, how much money am I going to throw at this? Because not all SPACs will get deals done. Some of the deals will be crap. And the way I think about it is like Michael Milken changed the world when he came up with selling junk bonds. And his pitch to institutions was he would go in and say, buy a basket of this crap okay, which was basically companies that had a higher chance of going bankrupt than what most insurance companies and institutions would buy, which was, high grade corporate bonds that, had low risk. And he said, look, your high grade portfolio, this was in the 70s. So, your high grade portfolio is yielding, 6% and you have no risk. Guess what? With the portfolio I'm going to sell you, it's like all the companies are high risk. 15% may default. Oh, and by the way, after those 15% default, your return is going to be 8 or 10%. So after you assume 100% of the risk and the worst case scenario happens because these are riskier companies and 15% go bankrupt, your return is still going to be much higher with lower risk than just buying the investment grade and yielding much lower. So that's how I'm thinking about these SPAC warrants. Is obviously I want to bet on the highest jockey. 2, I want to bet on the ones that have just collapsed. And 3, some of them have companies in them that are in line with what is going to be promoted. Whether they work or not in the long term, most of them won't. But, the first shakeout is among us, and you've got a 5-year look. So what you can do is you can buy a basket of these that with high quality people in charge, and 80% of them probably won't work because either a deal won't get done and the money will have to be returned because there's a 2-year stopwatch. Otherwise, they got to they got to get a deal done in 2 years. Otherwise, the money's got to be returned, which is why hedge funds buy them, because it's basically low risk and all upside, because if you don't like the deal, you get the money back. You just lose use of the money for the 2 years, although you can margin against it. So anyway, that's why the deals get done. So it's got to be a decent enough deal. So some won't get done. The money gets returned. The warrants are worthless because the stock's not going to go up if and the way to think about warrants, it's more complex. It's just an out of the money call option, 5 years out to 7 years. Some of these warrants go out to 2027, so 6 years. 4, 5, 6 year warrants near the money. I mean, they're all at $11.50. The SPACs are at $10. Obviously, there'll be dilution when they do pipes, equity pipes to supplement the deals. But leaving all that aside, some of them are going to work. And let's say 80%. So let's say you buy a basket of 10 of these that you like, that either have done a deal and crashed or not done a deal yet, but have a good promoter. 80% fail, 20% work. Out of those 20%, those $1 or $2 warrants that are 5 years out go to 10x, and the other 10% you could get 30 or 40x. So if you're getting on average 20x on 20% of the portfolio that works and 80% doesn't work, you can do the math. Like it's worth taking, if you took 3% of your portfolio equity or 1% of your portfolio equity or 2%, and you put it in, 10 of these companies that you like, expecting 80% not to work, but the 20% to work exceptionally well, and in some cases be, phenomenal companies, it's a unique opportunity to buy long-dated premium in what could be interesting companies at the beginning of a business cycle. Usually SPACs are late cycle, which is why a lot of these managers are brain damaged, and they say 66% say we're late cycle when we're actually early cycle. So it's a combination. It's a combination of a lot of great things that I've learned in my career coming together in one place, and I just wanted to share it with you. I can't really pound the table on any of the names because I have no way of knowing if they're going to work. When I pound the table on stuff, it's like a company that's been in business for like multi-decades. I know they're in a trough. They're going to recover. I tend to promote large cap stocks, and, for the trading service, we do, in the money spreads, either put spreads or call spreads, mostly call spreads. And for clients, we do all the above. We do long dated options, we do warrants, we do stock, we do everything. But this is a unique opportunity, and my view is you want to have some exposure here. So Al Root. So I'm just going to cover some things. Al Root did an article in Barron's 4 electric vehicle charging stocks at fire sale prices. So when these came out, they were all hyped. There were a lot of electric car companies like Fisker and Nikola. These things are down 50 to 90%. And, like a Nikola is like now a hydrogen play. And Jeff Ubben of Value Act was on saying like people don't understand it. Stock was up 30% this week, but it's fallen 90%. So, if it goes from 90 to 10 and then it goes to 13, you didn't miss anything. I'm not saying Nikola is going to be, I have no idea. My nature is not in buying new IPOs, buying new stuff that's unproven. But after all the hype is like knocked out of them and I can get my mind around it, and it's kind of a unique situation where you can get this long dated premium. So you can get exposure to a lot of companies with leverage for very little money, expecting 80% of them not to work, managing the risk with how you size it, whether it's 1%, 2%, 3% of your equity, and then it's spread across 10 companies with, 20% that'll work, and there'll be, 20, 30, 50, 100x, maybe another 5 or 10% that'll work 5 or 10x, and then 80% that'll be zeros, either due to crappy deals or not getting a deal done, and then the warrants are worthless. But these are some of the groups. So he goes into this 4 electric vehicle charging stocks at fire sale prices, and you can still buy warrants on these. So these were SPACs. He covers Checkpoint, I think SNPR, which is Volta, and you don't know which is going to be the winner, Evox, TPGY. But, these are some you can start to look at. I mean, you got to do your own work on this. I like this one. Legendary investor Bill Miller says the window's closing on the SPAC market, but singles out 2 names that remain attractive. I totally agree with him on these. Desktop Metal, he pointed out, and one of these companies that does insurance by the mile, like you only pay based on how much you drive, and I think that's called MILE. I think MILE is the ticker. So, this is how I think, so he's buying these things after they get smashed. I'm the same thing. I don't know if he's buying the stock or the warrant. It doesn't really matter. There's opportunity to do here. Fisker's another one. Goldman's downgrading it. Bank of America's upgrading it. Fisker could jump another 116%. Well, it's down like 50%. So, because their reservations are rising, who the hell knows? I mean, Fisker was around 10 years ago doing pipes and raising money. They flushed through a ton of money back then. They might have been early, but look, they're still around. So that, either they're just great salespeople or maybe there's something with the new Ocean SUV. I have no idea, but I would, if it's 1 to 3% of the portfolio, and then of that 3%, it's only, 30 basis points because I got 10 names. It goes to zero, but it could be 10 or 20x. It could be a NEO. I don't know. I have no idea. I'm sure there are people that think they know. I don't think like that. I think like Michael Milton. And you buy a portfolio of the risky stuff, 80% of it doesn't work. The 20% that does just pays in spades, and you've got time, 5 to 6 years on some of these long dated premium. I think it's interesting. Nikola is another one. So that they're now they're not a EV company. They're a hydrogen company. I have no idea. Maybe it'll work. Maybe it won't. It's down 90%. There's a good name bagged in it. He'll do something to make it work, or he won't. But you can get long dated warrants for that. Okay, moving on. All the staples companies we've been talking about came out and said prices are going up this week. P&G crushed it. Kimberly-Clark sucked today, their earnings, but I see that as I think that's a buying opportunity. Why do they suck? Because the same reason some of the tech companies may have headwinds next week. It's because they pulled forward a lot of growth when people were buying every piece of toilet paper that was available for sale within 100 miles of their house last year. Well, naturally, they bought less toilet paper this year because they're not worried about not having toilet paper. So Kimberly-Clark, did poorly. They took their guidance down a little bit. I still think the company's cheap. I think that's an opportunity. It's not one of our heavyweights, but it's, I think there's, I think that's an opportunity. Usually it takes 3 days to settle out after the bad news. But I think if you look three plus 4, 5, 6 months out, I think we could see new highs on that, but we'll take it as it comes. I mean, again, with all of these, you need to have a basket, but P&G was good. Coca-Cola was good. I think on balance, you're going to see more good stuff. And all this stuff about inflation and prices going up, that's just going to be passed on to the customer. That's going to be part of inflation. And then you'll see it in wages, etc. Here's an article by Andrew Barry and Barron's. Packaged foods boomed during the pandemic. Why their stocks still have room to run. So he goes through the whole article here, and that's a theme that we like. He points out Campbell's Soup, which is one of our holdings, as well as Kellogg, and we like those. We think they've got more room to run despite their recent move. Fed's inflation blind spot already surging grocery and housing prices. Well, we've pointed that out in the recent weeks. You can see the data here. Look at the CRB food index. So core inflation, they take out food and energy, the things that most people spend most of their budget on. That's why inflation won't be transient. But I also don't think it's going to be any crazy hyperinflation. So, I just think we're gonna revert back above trend, and that'll be constructive. It's a sign of demand for capital. It's a sign of growth, and it will be very good. Here was the CEO of Intercontinental Hotels saying that demand may exceed supply as he sees a surge in bookings. That's goes without saying. We've got another swim meet in Florida at the end of June. We luckily got the last beachfront set up there. Like no one had anything. We randomly got one of the people that we called who said we don't have anything left to give us a name for someone else who might have one, and they got their last beachfront thing, and it is what it is. So all right, Wells Fargo has used its lockdown time well. The article here in Wall Street Journal by Telis Demos is basically saying that Wells Fargo has positioned itself to be a big beneficiary from rising rates. So in effect, Wells Fargo asset cap also acted like a deposit cap. So he basically just lays out as rates rise, no one's better positioned. And Wells Fargo shares have already risen the most among S&P banks this year, up over 40%. Still, its price to tangible book value remains well below its 5-year average, while big U.S. banks overall are solidly above that average. Wells Fargo may be the rare reopening trade that isn't maxed out. I couldn't agree with him more. That's Telis Demos over at Wall Street Journal. So that was a nice article to see today. Moving right along. By the way, if you're on the podcast, we're going to click off in 2.5 minutes. Just go to the website and click on the VideoCast, the YouTube video. Fast forward to minute 60. You'll pick up right where you left off, word for word. If you want to go back and look at some of the charts we've covered, you may want to do that. We're actually going to get into some charts on Chinese stocks and SPACs and clean energy stocks. So you may want to definitely see those visually. So just go back a few minutes and you'll be able to see those. This article by Steve Goldstein over at MarketWatch. Get ready for $178 billion of selling ahead of the capital gains tax hike. These are the stocks at risk most. Number one, $178 billion is not a lot of money. Two, what we find in the last 3 times that the capital gains rate was hiked in 1987, 88, and 2013. The stock market was up the 6 months after the hike. So it's not the end of the world. But he's saying these NASDAQ stocks that have had the biggest 1-year moves are going to be the ones to get hit first. The Teslas, the Penn Nationals, the Etsy's and that type of stuff, Peloton. So we'll see. I mean, it's a sensational headline, but when you drill down into what it says, it's saying you don't really have to worry. And I think that Ryan Dietrich over at LPL put it best in this table. In 2013, the old rate was 15%. It went up to 23.8%. And you look over the following 3 months, 6 months, and 12 months, the market was up. Actually, the market was up 25% after that, so that didn't hurt. In 1987, it went from 20 to 28%. Again, it was up 3 months, 6 months, 12 months. In 1976, it went from 36% to 39 and change. It was up in 3 months. The stock market was down 12 months later, 7.7%. And in 1969, the market was down. So recently, the market has appreciated after capital gains tax rates went up. In longer back, it depreciated, but on average, it's up 4.3% 12 months later. So that's number one. Number two, I don't think that, as I said in the quote, I don't think they have enough votes to get it done in the Senate. So my guess is there is some compromise that is met. And if it's not 43%, maybe it's, 28%, something like that for people earning over $1 million, which is, it's probably not the end of the world. Keep in mind, a lot of money is institutional anyway, and don't pay taxes. So it's not a good thing. It's not the end of the world. And this is the data. So thanks to LPL and Ryan Dietrich and I guess Ned Davis Research for putting this together. And then this is just a summary that Ryan Dietrich put out at LPL of the performance year to date. As you can see, financials and energy are the top two performers for the year, despite taking a rest over the last 4 weeks. We'll see if they kick back into gear. And utilities, healthcare, and staples went positive after being very negative when we started suggesting them at the end of February, early March. So that's that. The Johnson & Johnson vaccine, after the bell, was now approved to resume in the U.S. as anticipated. Carlton English put out an article, SPAC IPOs fall out of favor after the hot streak. So most people view that as negative news. I think that's an opportunity, which we've discussed in pretty decent detail so far. While the new issuance has slowed to a drip, it may not be the time to shed tears for lost bankers' fees just yet. Goldman Sachs estimates that SPACs could drive $900 billion in merger and acquisition enterprise value over the next 2 years, meaning the deal makers could still pocket fees on so-called de-SPACing, from going from being a SPAC to buying a company. Right now, Goldman Sachs estimates there are 394 SPACs with $128 billion of equity capital seeking new opportunities. So we're going to see a lot of deals. Some public companies will... So anyway, there's going to be a lot of deals done, and that's why I'm saying if you have a basket of 10 or 20, those deals get done, the stock goes up. If it's a good company, it could go up a lot, and you own it at $11.50 for $1.50. And what if you do get a good company that 5 years out is up to $50, and then you exercise that warrants, you own it at $10, you could own it for 10 years and think it'd be a $200-300 stock with effectively a $1 basis. So that's pretty exciting to see. And then so this is the Chinese stocks. Just want to give you a glimpse at how beaten down they've gotten over the last few months, and where there may be some opportunity. So this is mid cap and above. You can see, and you really want to go for high quality. So you look at Beely starting to jump. You look at, Douyu, YY, Huya, Weibo, and, Baidu is beaten down. And I'm not pointing to anyone because they could roll back over, but, some of these have gotten cheap enough that you want to start to nibble. I start at the high end of the food chain on the casino reopening, like a Melco, like a Las Vegas Sands, which is now a pure China play. But these are some of the names, BZUN. Alibaba, I think, is very interesting because Charlie Munger bought a lot of it recently after this sell-off. So I think the government intervention fears are certainly real, and they'll continue to meddle, but they're not going to destroy the company because so many small businesses depend on Alibaba, and employment depends on Alibaba, and the consumer, it's a play on the consumer coming back, which we talked about a lot at the beginning of this call. So Alibaba is a high quality company. IQ for sure. Huya, basically the Netflix and online gaming platforms. So you just want to go as high quality. Baba probably fits that bill better than any of them. And then you go down the food chain from there if you want a little more speculation. But again, none of these, it's not like a Pfizer where I can pound the table, or Novartis where I can pound the table where I have great certainty. So with these, you have to buy baskets. But, some of them have come down enough that I think there's some opportunity here. XPEV, that, by the way, that's a EV car manufacturer. So some of these, you got to take a look at. You don't go dramatically overweight, but at these discounts, XPEV is down almost 50% in 2 months. Baidu 30-40%, Douyu 50%, YY 33% down. Beely was down 37% ish. So, these are opportunities. How much is Baba? Where's Baba? 220. These things are down 30%. These are huge companies that, they didn't lose 30% of their business in the last 7 weeks. That's for sure. So that's another pocket of opportunity. And then this is just, I have a bunch of IPOs because it just shows how some of these SPACs have really come down. They went up on the hype. Not all these are SPACs. This is a screen of IPOs, but a lot of them that you'll see that have just crashed down to $10, those are SPACs. So they rose up to 24, they crashed down to 10. That means either they announced a deal and now the company's waiting, now the investors are waiting for earnings to see if the company is worth it. They rose on anticipation of a deal, sold the news. Now you get to see if the company's worth anything. Those are probably better in terms of lower risk if the company is not a complete, dog, because, you don't have the risk of a deal getting done. Now you're just risking on, is the company worth it? And can it grow at the pace that people anticipate, etc.? So you can just see all of these busted SPACs, and that's when I like to go in. At the time of max pessimism, when people are saying SPACs are over, the warrants have gone from $6 back down to $1 or under $1, and you can pick up a bunch of them and a portfolio expecting 80% not to work. Here's a website, SPACtrack.net, for those of you who want to drill down. And what's great about SPACtrack.net is that I wish I had this, actually. Anyway, so you can click on the warrant link of each of these and just see how these warrants have just, collapsed across the board. And then you can also scroll to the right. I can't show you here because it's not fitting in my screen, but if you scroll to the right, once you're on SPACtrack.net/closed SPACs, you can see the principles. So Greg Smith, Bill Foley, Byron Roth, Howard Ludnick over at Cantor, Alec Gores, SPAC King, Chamath Palihapitiya, Tillman Fertitta. So, you go for some of the names that you feel comfortable with. I'm not saying that Alec Gores, I'm not saying any of those are necessarily it, but, you can see Dan Loeb's got a SPAC. So there are a number. James Dolan has a SPAC. Barry Sternlicht has a bunch of SPACs. All right, so there are a lot of SPACs. Go for the high quality names. And by the way, these are not appropriate for everyone. I only deal with accredited investors. This is opinion, not advice. I'm just saying it's a really unique opportunity in terms of timing, in terms of structure, in terms of opportunity. So you got to do your homework. I can't pound the table on any one of them because I know 80% of them won't work, but I do know the 20% that do will make me well more than the 80% that don't, and I keep it small anyway, but I want to participate. So the article of the week was the Hughes Corporation rocked the boat. We're going to get right through it. We covered a lot of it. Banks blew the doors off. Here's, Wells Fargo. If you remember, we put out that Cobra Kai sweep the leg article. This was the exact date, September 24th. It's up more than 97%. It's probably up 100% as of today. In just 7 months or whatever it is. These were estimates when I put out the article on Wednesday, 178 to 203. They've gone up now to 180 for 2021. We covered the interview with David Lin, and this is what's happened to utilities, staples, and pharma since we put it out. AEP up 20%, Dominion up 19%, Kellogg up 15%, Campbell Soup up 13.5%, Pfizer. These were the laggards, by the way. The drug stocks was lagging, and now was up 18%. So these may take a breather before their next leg up, but I think they've got more room in coming months. Novartis is the laggard. I think that there's still great opportunity there. The rest were hodlers of diamond hands, as they say. So we've covered a lot of that. And then we covered moving forward where the puck is going. We're starting to see some very selective opportunities in broken down high-quality Chinese stocks, clean energy, Green New Deal stocks, and busted SPACs. A lot of the clean energy, Green New Deal overlap with SPACs, so you can get bang for your buck and control a lot of them for very little money with the warrants. Okay, sentiment was at 57% for retail, still exuberant. The fear and greed was mid-level at 58%, and the active managers were up to 95% as we expected. Holding the bank's energy and defense, we think, we'll peel some off on the way up, but we want to hold these core for the first 3 years of the new business cycle. We like our utility, staples, and pharma for another few months. We think they've got another leg up. And then we're starting to dabble in the Chinese stocks, some of these SPAC warrants, / clean plays, and there's also some real energy stuff to buy on the dip as well, like real energy, not clean energy, which will become clean energy because they'll do carbon capture, et cetera, but that's a whole nother podcast, and that's the story. So usual activity, we saw some in Li, which is a Chinese EV company this week. We saw some in Valero, which is a refiner, 22,000 contracts for the June 80 calls. They haven't reported yet. Russell 2000 earnings, we did top 30 weights. Their cumulative earnings power has gone up by 2% in the last 60 days. NASDAQ, we did the top 30 weights, and their top 30 stock weights was revised down by 2.96% in the last 60 days. For that's 2021 earnings. So, tech earnings are going to be very interesting this week. It's going to tell us a lot, and it will affect the general indices depending on how they guide. I think guidance is going to be tough because a lot of growth was pulled forward, but we're going to see how that plays out. It could be bifurcated where the advertisers like Google and Facebook continue to do well, and some of the others that pulled forward a lot of growth maybe don't have strong enough guidance. We'll see how that shakes out. As far as economic data, crude was a modest build. Let's see. Initial jobless was better than expected. Continuing claims is stubbornly high. That's the most important number. That is not good. So we got to keep an eye on that. Existing home sales were negative due to rates being higher. Existing home sales, the number missed expectations. That should start to come back. I think there was some data out today that started picking up with rates starting to compress again. And it's the beginning of the spring season, so we'll see how that plays out. Manufacturing PMI beat expectations. Services PMI beat expectations. New home sales crushed it. 1.021 versus 886,000. They were up 20.7% month on month, which makes sense if the supply is tight. That the new supply would be where the demand is. So that's actually very positive to see, the new home sales. And the rig count was down one this week. So yeah, it took a break, and everything else looks pretty good. Earnings for next week, it's all about big tech. This week, big beats, and 25% of the S&P 500 have reported. 84% have reported positive EPS surprise, with 77% of the companies positive revenue surprise. If 84% is the final percentage of the bottom line beat rate, it will tie the mark for the highest percentage S&P companies reporting a positive EPS surprise since FactSet began tracking this metric in 2008. So right now, the forward 12-month PE ratio for the S&P 500 is 22.3 versus the 5-year average of 17.9 and the 10-year average of 16. So that's why I say in the article, it's priced for perfection based on what we think earnings are today. I think what we think today is too low. And sure enough, this week, earnings came up yet again. If you remember from Wednesday when I did the article, it was 178. Last week when I did the show with David, it was 176. And now it is 180.13 for 2021, 204.12 up from 202. So these estimates keep going up, and I think they're going to jump a lot more by the time earnings season is done. So very positive things to come. Thanks for tuning in this week. We had a tremendous amount to cover after 3 weeks of Thursdays and a lot of travel. Hope you found that helpful, some new initiatives, and make it a great one. We'll be back next week, same time, same place.